Welcome to Accounting Focus, everyone. My name is Richmond, a young chartered accountant, and today's episode will focus on solving past standard questions under IAS 2. Our previous video focused on laying down the principles. So to make the principle more understanding and more practical, we are going to solve a past question specifically from Institute of Chartered Accountants, Ghana, and then we see how to break down the question, all right? Now, you realize that before I mentioned to you that inventory can be complicating sometimes. It can be very complicated. It's an important standard because there are instances where companies classify certain items as inventories when they are not supposed to be treated as inventory. So it is very important that you get the principles, and then we also solve some practical exams questions so that it makes the understanding more practical, right? So, not to waste time, let's look at the question for today. Temale Manufacturing. So it's a manufacturing company. Temale Manufacturing. So Temale Manufacturing. So let's take some time to go through the question so that when you are solving, we can just pick the figures and then move on. Temale Manufacturing was formed on 1st January 20x5. The entity manufactures and sells a single product and values it on a first in, first out basis. Remember I mentioned FIFO in our previous video, right? 1 ton of raw material is processed into 1 ton of finished goods. So I'm here. This is very important. 1 ton of raw material is processed into 1 ton of finished goods. Okay. The following details relate to 20x5. So purchases of raw material. So they've given us the breakdown of the purchases of those raw material. They said purchases 1,000 tons of raw materials per week. And then price from 100,000 Ghana cedis per ton on 1st January, increasing to 150,000 Ghana cedis per ton on 1st July. So they've given us the price range. Okay. Import duties. That is 10,000 Ghana cedis per ton. Transportation from dock to factory. That is 20,000 Ghana cedis per ton. So you realize that all the figures they've given us are in tons, right? Per tons. Okay. Production cost. So everything, all the information they give us from here to here is under raw materials. So all those costs are in relation to raw materials. And I hope you are getting it. All right. Production cost. They said the production capacity is 1,500 tons per week. So they have the capacity of producing 1,500 tons per week of finished goods. The variable cost incurred per ton is 25,000. And then the fixed cost per week. So you realize that the cost that we are ascertaining are supposed to be in tons, right? But then this fixed cost has been given to us per week. So we should be able to convert it into tons. Now, even though they said the production capacity is 1,500 tons per week, all right, so even though they are saying that the production capacity is 1,500 tons per week, it doesn't mean that every week they produce 1,500. Are you getting the principle? They said 1 ton of raw material is processed into 1 ton of finished goods. So if they buy 1 ton of raw material, it is equivalent to 1 ton of finished goods. So if every week they are purchasing 1,000, even though their production capacity is 1,500, what it means is that they are only producing 1,000 per week. So this fixed cost, to get the per tons, we have to divide this. So we have to divide this by 1,000 tons, not by 1,500. Are you getting the principle? Okay. Then we have the sales details. So the sales detail is saying that selling price 240,000 Ghana cedis per ton. Delivery cost to customers, that is 8,000 per ton. Selling cost, that is 4,000 per ton. So this will help us ascertain the NRV. Don't forget that we said to measure inventory, it should be at a lower of cost and net realizable value. So they're giving us the cost component. We are going to add up all the components of the cost, and then we compare it to the NRV after we've computed it, and then we see which one should be valued, which one should the finished goods be valued at. So inventories at 31st December 20x5. These are the closing inventories. Okay. These are the closing inventories. Now it says that so after we've ascertained the cost, we'll have to come and multiply it by these closing inventories here. Okay, so that we know the total amount at which the inventories were valued at. Then we are saying that there is a ready market for raw materials and the NRV of the raw materials is higher than its cost. Automatically, if they are saying that NRV of the raw materials is higher than its cost, it means that we can solely rely on the cost of the raw material. And then that is what at the end of the period, we will use it to value it. Are you getting the principle? All right. Now required, calculate and disclose the value of inventories at 31st December 20x5 in accordance with IAS 2. In accordance with IAS 2. So this is actually one of the technical aspects of inventories. And then let's break it down. Let's break it down quickly. So let's focus on the cost. So the cost of inventory, and it is per ton. So because they've given us the closing inventory in total, you just have to find the per ton and then we use it to multiply the total tons at the end of the period. Is that not it? So the purchases, we talked about purchases. So that is 1,000 tons of raw materials per week. They are saying that price moved from 100,000 to 150,000. So the purchases, I'm going to take the 150,000 because it's moved from 100,000 to 150,000. And they didn't tell us as a when we bought those goods. So to be on the safer side, we go with 150,000. Then import duties. Import duties, we have to pick that figure. Import duties, so import. And you understand why, because this is associated with the purchase of those inventory. So import duties is 10,000 per ton. So 10,000. So Ghana cedis here, 10,000. Then there was transport from docks to the factory. From docks to the factory, this is a delivery cost. Is that not it? So we have to add that one, transport. So transport, that is 20,000. Let's get our calculators. So eventually you've been able to ascertain the total cost, because we mentioned that the whole of this side is just talking about the cost of those raw materials. And I want to separate the cost of the raw materials before I add up the other components which led to the finished goods, because we need that total cost. So we are going to have 150,000 plus 10,000 plus 20,000. And that is giving us 180,000. So this is the cost of raw materials per ton. You agree? Okay. Now, the production cost. They mentioned that variable cost was 25,000 per ton. And this variable cost, we don't know what the makeup of that variable cost, but we know that if you are converting raw materials to finished goods, the cost of conversion, there are some variable costs in there. So variable cost should be added. So variable cost of 25,000. And you agree? Then we have fixed cost. So fixed cost, do you remember I said we are supposed to divide the fixed cost by 1,000 tons by 1,000? Why? Because we are saying that the fixed cost here, so we are saying that the fixed cost here was 30 million per week. And we have to ascertain the per ton. Is that not it? So if you have to ascertain the per ton, we have to take in their normal production. So in a week, how many goods are they able to produce? It's not the same as their production capacity. You can have a production capacity of 1,500 and you can still only produce 1,000. That is a decision you will make, right? So we are using the purchases. Why? Because they said the 1 ton of raw material is processed into 1 ton of finished goods. And every week they purchase raw materials of 1,000 tons. So that was what helped us. So we are going to have 30 million divided by 1,000. Do you agree? All right. So we are going to have 30 million divided by 1,000, and that will give us 30,000. So that is per ton, 30,000, right? So I think that is all for the cost of the asset. Sorry, the cost of the inventory, the total cost of the inventory. So when we add everything here, we are going to add 180,000 plus 25,000 plus 30,000. Okay, so that is giving us 235,000. So this becomes the cost of finished goods. Do you agree? Do you agree? Okay. Now, there is sales details here, and that is what is going to help us compute for the NRV. Do you remember? And we can only compute the NRV because they are saying sales. Sales means that obviously it is after we have converted the raw materials into finished good. That is when we make the sales. Good. So this information here is in relation to the finished goods. So let me make that computation here. So net realizable value. So what is the formula for net realizable value? It should be your selling price minus your what? Your cost to sell. Sorry, cost to complete, if any, and then minus your cost to sell. So we have our selling price here. They've given us the selling price per ton. So that is 240,000 Ghana cedis. 240 Ghana cedis. Good. Then we have delivery cost to customers. Delivery cost to customers and then selling cost. So this delivery cost to customers and then the selling cost, they are one. They are all costs that we must subtract from the selling price. Because if, assuming you are selling something to someone and it is 10 cedis or $10, let's take $10. So you are selling something to someone and it is $10. Okay, let's take this calculator. I'm selling this calculator to a customer and it is $10, right? But I am bearing the delivery cost. So when I deliver this to the person, I'll incur, let's say, $2 delivery cost. I am incurring it. So it means that delivery that I've made, I have to subtract it from the amount that I'm selling the calculator for. And that is what? That will give me 8 cedis. But then there are other selling costs that is attributed to me selling that particular. It will be that, okay, I give the work to an agent and that agent is billing me. So any form of cost attributed to this particular selling of the asset, I may subtract it. So less selling cost. I'm going to have, so 8,000 plus 4,000. 8,000 plus 4,000. That will give me 12,000. So let's subtract 1,000. So let's subtract this from it. So we are going to have 240,000 minus 12,000. So we end up getting 228. So this is the NRV. Now, what is the principle? The principle is that inventory should be valued at the lower of cost and net realizable value. So now NRV is this. What was the cost of the finished goods? The cost of that finished goods was, let's confirm from here, that was 235,000. So between these two, the lower of cost and net realizable value, we should take between these two, we should take the lower amount. So it means that the actual value we will give to the finished goods will be what? 228,000 and not 235,000. Are you getting the principle? Okay. So that is it. So let me clean this. Okay. So now the question says that calculate and disclose the value of inventories. You should calculate and disclose the value of inventories at the first day by 20x5 in accordance with that. So at the end of the period, raw materials, in relation to raw materials, we are going to have 2,000 because that's the closing inventory, right? Times. Now, do you remember I said we needed this raw material? We needed this cost, this 180,000. So times 180,000. And we don't have to compare it to anything. Why? Because they mentioned it over here that there is a ready market for raw materials. And the NRV of the raw materials is higher than its cost. Inventories are valued at a lower of cost and it's net realizable. So obviously, they're saying that means that the cost is lower. So you are going with that. And then the finished goods is also 2,000 closing stock times. So this is what I'm getting the 2,000 from. This one. Okay. 2,000 times. Now, do I take the 235,000 or do I take the 228,000? And we've agreed that we have to go with the 228,000. Good. So by 228,000. So why are we picking the 228,000? We are picking the 228,000 because we are looking at the total cost. The total cost. Okay. The total cost. Are you getting the picture? The total cost. So we are going to have 2,000 times 180,000. So that's 360 million. So let me put some zeros up. So 360,000. Right. Then 2,000 times 228,000. That will give me 556 million. So 556,000. Okay. So when you add 556,000 plus 360,000, what do we have? You end up getting 816,000. Okay. So we end up getting 816,000. So this brings us to the end of the computation. If you have any question, drop it in the comment box and I'll address it accordingly. Okay. Also then, because so there will be another question on the inventory. So stay with us, and by the end of the entire thing, you realize that you become very, very confident when it comes to IAS 2. So until then, we call it a day. If you've not subscribed, kindly subscribe. If you like this video, hit the like button, share to your friends so that it will reach other people as well. Okay. Bye-bye.